You work hard, you save money, you follow the rules, you invest in your 401k, you pay your taxes, you do everything you're told will lead to financial security. And yet, every few years, something happens. A crisis, a crash, a shock. And when the dust settles, you're poorer. Your savings bought less. Your wages didn't keep up. Your house lost value or you couldn't afford one in the first place. But the rich, they're richer. Every single time. This isn't bad luck. This isn't random. This is a cycle. A 7-stage wealth transfer machine that's been running for over a century, moving money from your pocket to theirs, crisis after crisis, decade after decade. The same pattern. The same stages. The same outcome. The rich always win. Not because they're smarter, not because they work harder, because they built the game, and you're playing it without knowing the rules. Let me show you the 7-stage cycle that explains why you always feel behind, even when you do everything right. Why every crisis makes them richer while you struggle. Why the system isn't broken, it's working exactly as designed. Once you see this pattern, you cannot unsee it. This is the cycle. 7 stages that repeat over and over, transferring wealth upward each time. Stage 1, narrative setup and distraction. You're told a story. This time is different. We've fixed the problems. The system is safe now. New policies, new technologies, new financial products are introduced as progress. Stage 2, credit expansion and easy money interest rates drop. Money becomes cheap. Credit flows everywhere. You're encouraged to borrow. Mortgages, student loans, car loans, margin accounts. The wealthy borrow too, but at a scale you can't imagine, and with protections you don't have. Stage 3. Asset inflation and paper wealth stocks soar. Housing prices surge. Asset values rise faster than wages. If you own assets, you feel rich on paper. If you don't, you watch prices move further out of reach. The wealthy own most assets, so their wealth compounds exponentially. Stage 4. The trigger. Something breaks. A credit event, a war, a pandemic, a policy shift. The bubble bursts, panic spreads, forced selling begins. You're caught holding the bag. Stage 5. Bailouts and consolidation. The government steps in to save the system. They rescue banks, corporations, and large institutions. You lose your home, your equity, your business. The elite buy distressed assets at fire sale prices with cheap liquidity and insider access. Stage 6. Inflation and financial repression. Money printing accelerates. Inflation erodes your cash savings. Bonds lose real value. But real assets, stocks, real estate, businesses owned by the wealthy, recover and surge to new highs. Stage 7. Narrative rewrite. The crisis is explained as a once-in-a-generation event. New regulations are introduced that appear to fix everything but actually protect the biggest players. The story resets. This time it's different. And the cycle begins again. This isn't conspiracy theory. This is documented history. Let me show you how this exact cycle has played out again and again for over 100 years. Let's start with the clearest example. The 1920s and 1930s. This was the first modern wealth transfer on a massive scale. Stage 1. The narrative. The 1920s were sold as permanent prosperity. A chicken in every pot, a car in every garage. The stock market was the path to wealth. Ordinary people were told they could get rich by investing. Stage 2. Credit expansion margin lending exploded. You could buy stocks with just 10% down, borrowing the other 90%. Banks loaned freely. Credit was everywhere. People borrowed to speculate. Between 1921 and 1929, the money supply expanded by 60%. Stage 3. Asset inflation stock prices tripled between 1924 and 1929. Everyone felt wealthy on paper, but wages didn't keep pace. By 1929, the top 1% owned 40% of the nation's wealth. The bottom 93% owned just 20%. Ordinary people were buying stocks at the peak with borrowed money. Stage 4, the trigger, October 1929. The market crashed. Stocks lost 89% of their value by 1932. Banks failed by the thousands. 9,000 banks collapsed between 1930 and 1933. If you had money in those banks, it was gone. No deposit insurance existed yet. Stage 5. Consolidation. Who survived? The largest banks. JP Morgan, the Rockefellers, the Mellons. They had cash. They bought assets for pennies on the dollar. Farms, factories, real estate, entire companies. Small banks died. Small businesses died. Ordinary people lost everything. The elite consolidated power. By 1933, the top 0.1% owned more wealth than the bottom 90% combined. Stage 6. Inflation and repression. Roosevelt took office. He devalued the dollar by 40% against gold. He inflated the money supply. If you held cash or bonds, your purchasing power collapsed. If you owned real assets, you recovered. The wealthy who bought assets at the bottom saw massive gains. Stage 7. The narrative rewrite. The story became, speculation was bad, we fixed it with regulation. The SEC was created, deposit insurance was introduced. Glass-Steagall separated commercial and investment banking. All of this made the system appear safer. But the biggest banks were now bigger and more powerful than before the crash. The cycle completed. Wealth transferred from millions of ordinary people to a few thousand elites. And then it happened again. Let's jump forward. The 1970s. The same cycle, different mechanism. Stage 1. The narrative post-World War II prosperity was supposed to last forever. The Bretton Woods system, where the dollar was backed by gold, made everything stable. You were told to save, buy bonds, trust the system. Stage 2. Credit expansion. The government spent massively on Vietnam and the Great Society programs. Deficits exploded. The Fed printed money to finance it. Credit expanded far beyond gold reserves. Stage 3. Asset inflation. By the late 1960s, asset prices were rising, but wages weren't. The cost of living climbed. But if you owned stocks or real estate, you were fine. If you were a saver with cash or bonds, you were falling behind. Stage 4. The trigger, August 1971. Nixon closed the gold window. The dollar became pure fiat currency. Inflation exploded. By 1980, inflation hit 14% annually. If you had $10,000 in 1971, it was worth $4,000 in real terms by 1980. Stage 5. Consolidation. Who survived the 1970s? People who owned hard assets, real estate, stocks in commodity companies, gold. The wealthy who could afford financial advice and alternative assets protected themselves. Ordinary savers holding cash and bonds got destroyed. Stage 6. Inflation and repression. Inflation transferred wealth from creditors to debtors, from savers to asset owners. The government inflated away the real value of its debt. The wealthy inflated away the real cost of their mortgages and business loans. You, the saver, lost purchasing power every year. Stage 7. Narrative rewrite. By the early 1980s, Paul Volcker raised interest rates to 20%, killing inflation. The story became, we defeated inflation through tough policy. What they didn't tell you, the wealthy had already positioned themselves. They bought assets during the chaos. When inflation finally stopped, those assets surged in value. The cycle repeated. The rich got richer. Savers got crushed. Now let's look at 2008. This is the clearest, most documented example of the 7-stage cycle in modern times. Stage 1. The narrative, early 2000s. You were told, housing prices never go down. Subprime is contained. Financial innovation has made the system safer. Home ownership was pushed as the American dream. Mortgages were given to anyone with a pulse. Stage 2. Credit expansion. Interest rates fell to 1% after the dot-com crash. The Fed flooded the system with cheap money. Banks originated trillions in mortgages. Securitization allowed banks to sell those mortgages as AAA-rated bonds. Leverage in the financial system hit all-time highs. Investment banks were leveraged 30 to 1. You could buy a house with 0 down. Stage 3. Asset inflation. Housing prices doubled between 2000 and 2006. Stock prices recovered and rose. If you owned assets, you felt rich. Homeowners pulled equity out of their houses to buy cars and vacations. The wealthy leveraged cheap credit to buy more assets. But your wages didn't double. The cost of everything rose faster than your paycheck. Stage 4, the trigger 2007. Subprime mortgages started defaulting. By 2008, the entire system seized. Lehman Brothers collapsed in September 2008. The stock market lost 50% in 18 months. Housing prices fell 30% nationally, 50% in some cities. If you owned a home bought at the peak, you were underwater. If you had stocks, you watched half your wealth vanish. Stage 5, bailouts and consolidation. The government stepped in. $700 billion TARP fund. The Fed printed trillions through quantitative easing. Who got saved? The banks. AIG, Goldman Sachs, JP Morgan, Citigroup, Bank of America. Who didn't get saved? You. 10 million people lost their homes to foreclosure. Unemployment hit 10%. Small businesses closed by the hundreds of thousands. And who bought the foreclosed homes? Private equity firms. Blackstone bought 80,000 single-family homes at discounts. Ordinary people were forced to sell. The wealthy bought at the bottom. Stage 6, inflation and repression. The Fed kept interest rates at zero for 7 years. They printed $4 trillion. Savers holding cash got 0% interest. Bonds paid nothing. But stocks? They tripled between 2009 and 2016. Real estate recovered and surged. The wealthy, who bought assets in 2009, saw generational wealth creation. You, if you were lucky enough to hold on, just recovered your losses. By 2016, the top 1% owned more wealth than the bottom 90% combined. Stage 7, narrative rewrite. The story became, we saved the system. We passed Dodd-Frank to prevent it from happening again. But Dodd-Frank made the biggest banks bigger. The top 5 banks controlled 45% of all banking assets by 2015, up from 35% in 2007. The regulations crushed small banks. The too big to fail banks became even bigger. The cycle completed. The rich won. Again. And then came 2020. The same cycle, but faster and more extreme than ever before. Stage 1. The narrative early 2020. The economy was strong. The stock market was at all-time highs. The recovery from 2008 had been long and steady. The longest bull market in history. You were told to invest, to participate. Stage 2. Credit expansion interest rates were already low coming into 2020. Corporate debt had reached $10 trillion. Zombie companies, firms that couldn't cover their interest payments with earnings, made up 20% of the market. The system was already over-leveraged. Stage 3. Asset inflation. Stock prices were at record highs. Real estate was expensive. Valuations were stretched, but you were told, don't fight the Fed, stocks only go up. Stage 4. The trigger March 2020. COVID lockdowns. The stock market fell 35% in 3 weeks, the fastest crash in history. Small businesses shut down overnight. 22 million people lost their jobs in 2 months. Stage 5. Bailouts and consolidation. The response was unprecedented. The Fed printed $5 trillion in 18 months. Congress passed $6 trillion in stimulus. Who got the money? Corporations. Airlines got $50 billion. Large businesses got forgivable PPP loans. The Fed bought corporate bonds, including junk bonds, directly. Small businesses? Many got nothing. Or got small loans that barely covered payroll for a few months. By the end of 2020, over 200,000 small businesses had closed permanently. Who bought the distressed assets? Private equity, hedge funds, billionaires. They raised record amounts of capital and bought real estate, businesses, and stocks at the bottom in March 2020. Stage 6. Inflation and repression. The money printing caused inflation. By 2022, inflation hit 9%, the highest in 40 years. If you held cash, you lost 9% of your purchasing power in 1 year. Bonds paid 1 to 2%, so bondholders lost 7% in real terms. But stocks? The S&P 500 doubled from March 2020 to January 2022. Real estate surged 40% in many markets. Bitcoin went from $5,000 to $69,000. The wealthy who bought assets in March 2020 made fortunes. The billionaire class added $5 trillion to their net worth between March 2020 and 2021. Jeff Bezos made $75 billion. Elon Musk made $140 billion. The top 1% captured 90% of all wealth created during the pandemic. You got a $200 check, maybe $600 more later, while inflation ate away your savings and wages. Stage 7, narrative rewrite. The story now: we had to save the economy. Inflation was transitory. Now we're fixing it. The Fed raised rates in 2022 and 2023, but the damage was done. Asset prices had already surged. The wealthy had already locked in gains. And now higher rates crush anyone trying to buy a house or start a business. The cycle completed in just 3 years, the fastest, most efficient wealth transfer in modern history. Let me break down the specific mechanisms that make this cycle work. These aren't abstract. These are concrete tools that transfer wealth from you to them. Mechanism 1. Inflation as hidden taxation. Inflation is a wealth transfer from savers to debtors and from wage earners to asset owners. If you hold cash, inflation destroys your purchasing power. If you hold bonds, inflation erodes your returns. But if you own stocks, real estate, or businesses, inflation pushes prices higher. The wealthy own assets. You hold cash and earn wages. Inflation takes from you and gives to them. Between 2020 and 2023, $3 trillion in real purchasing power was transferred from wage earners and savers to asset owners through inflation. You lost, they won. Mechanism 2. Bailouts socialize losses. Every major crisis involves bailouts. The government steps in to save the system. But who gets saved? Large institutions, banks too big to fail, corporations with lobbyists, small businesses, homeowners, workers. They're told to take responsibility. This is socialism for the rich, capitalism for everyone else. Losses are socialized. Profits are privatized. The pattern never changes. Mechanism 3. Monetary policy inflates assets, not wages. When the Fed lowers interest rates and prints money, where does that money go? Into financial assets. Stocks, bonds, real estate. Asset prices rise. But wages don't. The median wage in America, adjusted for inflation, has barely moved in 40 years. But stock prices have increased 20x. Housing prices have increased 5x. If you own assets, monetary policy makes you richer. If you earn wages, you fall further behind. Mechanism 4. Tax policy favors capital over labor. Income from wages is taxed at up to 37% federally, plus state taxes. Income from capital gains is taxed at 20% maximum. If you work for your money, you pay more. If your money works for you, you pay less. The wealthy earn most of their income from investments, not wages. So they pay lower, effective tax rates. Warren Buffett famously pays a lower tax rate than his secretary. This isn't a bug, it's policy. Mechanism 5. Financial products. Extract wealth. You're sold financial products designed to benefit the system, not you. High-fee mutual funds. Actively managed portfolios that underperform. Annuities with hidden costs. Student loans at 7%. Credit cards at 20%. Payday loans at 400%. Meanwhile, the wealthy access credit at 3%. They use leverage to buy income-producing assets. You use credit to consume. They build wealth. You pay interest. Mechanism 6. Information asymmetry. The wealthy have access to information you don't. They have financial advisors, tax attorneys, accountants. They know when to buy, when to sell, how to structure deals to minimize taxes. They have networks, insider knowledge, early access to opportunities. You get financial advice from cable news and TikTok. You're told to buy and hold while they're selling. You buy at the top, they buy at the bottom. Information is power, and you don't have it. The cycle works because you're told stories that keep you playing the game without understanding it. Stocks always go up in the long run. True, if you can hold for 30 years and don't need the money, but most people need money before 30 years. And if you buy at the peak, you might wait a decade just to break even. The wealthy can wait. You can't. You need to invest for retirement. True, but the system pushes you to invest through 401ks, where your money is locked up for decades. You can't access it without penalties. Meanwhile, the wealthy use tax-advantaged structures you've never heard of. Opportunity zones, qualified small business stock, 1031 exchanges. Real estate always appreciates, until it doesn't. 2008 proved that. But even when it does, If you're buying at peak prices with maximum leverage, you're not building wealth. You're transferring your income to a bank for 30 years while taking all the downside risk. Don't try to time the market. Good advice for the wealthy who are already positioned. Terrible advice if you're buying at all-time highs because you're told you can't time it. The wealthy absolutely time markets. They buy distressed assets. They sell into euphoria. They just don't tell you that's what they're doing. These stories are designed to keep you invested, keep you borrowing, keep you participating. Because the cycle needs you in the game. You're the exit liquidity. You buy at the top. They sell to you. You panic at the bottom. They buy from you. So where are we in the cycle right now, in 2025? Indicators suggest we're in late stage 3 or early stage 4. Asset prices are extremely high. The stock market is near all-time highs despite economic uncertainty. Housing remains unaffordable in most major cities. Debt levels are at historic peaks. US national debt is $36 trillion, 123% of GDP. Corporate debt is $13 trillion, as consumer debt is $17 trillion. The narrative is still bullish. AI will change everything. The economy is resilient. Buy the dip. Classic stage 1 language mixed with late stage asset inflation. But cracks are showing. Regional bank failures in 2023. Commercial real estate distress. Credit card defaults rising. Auto loan delinquencies increasing. Yield curve inversions. These are stage 4 signals. The trigger could be anything. Geopolitical shock. Debt crisis. Banking contagion. Policy mistake. Credit event. We don't know what or when. But history shows triggers always come. And when it does, the cycle will play out exactly as before. Bailouts for the big. Consolidation. Inflation. Wealth transfer upward. Let's be clear about who consistently wins and who consistently loses in this cycle. Who wins? Asset owners. If you own stocks, real estate, businesses, productive assets, you survive the cycle. You might lose 30-50% in the crash, but you recover and end up higher. The wealthy own most assets, so they capture most gains. Debtors with fixed-rate debt on appreciating assets. If you borrowed at 3% to buy real estate that inflates to higher prices, inflation pays off your debt in devalued dollars. The wealthy use this strategy at scale. Insiders with access to liquidity and information. The people who know when the Fed is intervening, who have credit lines that don't get pulled, who can buy at the bottom because they have cash when everyone else is forced to sell. Large institutions. Too big to fail means you get bailed out. You consolidate competitors. You come out bigger and more powerful. Who loses? Wage earners. Your income doesn't keep up with asset inflation. You fall further behind every cycle. Savers holding cash. Inflation and financial repression destroy your purchasing power. You think you're being responsible. You're being robbed. Small businesses. You don't get bailouts. You face higher costs, restricted credit, and competition from giants who got Fed support. People who buy at the peak. If you enter the market during euphoria, you're the exit liquidity for people selling. You hold losses for years. People forced to sell at the bottom. If you lose your job, face foreclosure, or need cash during the crisis, you sell at the worst possible time. The wealthy buy from you. The pattern is clear. Position in the system determines outcome. Not effort, not virtue. Position. I'm not giving financial advice, but I can explain choices people make when they understand this cycle. Choice 1. Learn the cycle and stop being surprised. Most people lose because they don't see the pattern. They think each crisis is unique. It's not. Once you see the 7 stages, you can recognize where you are. You can anticipate what comes next. Choice 2. Own productive assets. Holding cash long-term is a guaranteed loss in this system. Inflation will take it. The question is, which assets and at what price? The wealthy. Own businesses. Real estate. Stocks. Things that produce income and appreciate. They avoid holding large amounts of cash. Choice 3. Be wary of late-stage euphoria. When everyone says, you can't lose. When asset prices have doubled in 2 years. When leverage is everywhere. When the narrative is, this time is different. That's late stage 3. The wealthy take profits. They raise cash. They wait. You should at least be cautious. Choice 4. Understand that debt is a tool, not a burden, if used correctly. The wealthy use debt to buy assets. You're encouraged to use debt to consume. If you borrow to buy a car or a vacation, you're making banks richer. If you borrow at low rates to buy income-producing assets, you're using the system the way the wealthy do. Choice 5. Diversify across jurisdictions and asset types. The wealthy don't keep everything in one country, one currency, one asset class. They spread risk. They have options. You can think about the same logic at your scale. Choice 6. Build skills and knowledge the system can't inflate away. Your ability to produce value, solve problems, create, build, that's an asset that survives cycles. Invest in yourself. The 7-stage wealth transfer cycle is not a conspiracy. It's structure. It's incentives. It's the predictable outcome of how money, debt, and policy actually work. Every crisis since at least 1929 has followed this pattern: narrative and easy credit, asset inflation, a trigger and panic, bailouts and consolidation, inflation and financial repression, narrative, rewrite, and reset. And every single time, wealth moves from the bottom to the top, from wage earners to asset owners, from savers to debtors, from the many to the few. This is why the rich always win. Not because they're lucky, because they built the cycle. They understand it. They position themselves to benefit from it. They own assets. They use leverage. They have access to liquidity and information. They buy when you're forced to sell. They sell when you're encouraged to buy. You work hard, you save, you follow the rules, and every cycle, you fall further behind, because the rules were written by people who benefit from the cycle. The cycle is accelerating. The time between crises is shrinking. 1929 to 2008 was 79 years. 2008 to 2020 was 12 years. The volatility is increasing. The wealth transfers are getting larger and faster. By 2030, if the cycle continues, the top 1% could own more than 50% of all wealth. The bottom 50% could own less than 1%. We're not far from that now. This is not capitalism. Capitalism requires competition, creative destruction, and risk. This system privatizes gains and socializes losses. It protects incumbents and crushes newcomers. It rewards position, not productivity. You have a choice. You can keep playing the game blindly, doing what you're told, hoping it works out. Or you can learn how the cycle works and adjust your behavior. The rich always win because they see the board. You've been a piece on the board, but now you see it too. The 7 stages, the mechanisms, the pattern. Once you see it, you can't unsee it. The question is, what will you do with that knowledge? The cycle is already turning. The next crisis is coming. It always does. And when it arrives, the same thing will happen. The rich will consolidate. The system will be saved. You'll be told it was necessary, and wealth will transfer upward. Again. Unless you understand the game and play it differently. Welcome to the cycle. Population, everyone.